Hi, I'm Mark Russell, Chief Client Officer at Illion. Today's operating conditions can best be described by the notion the only constant is change. Coming out of COVID-19 into an economic downturn, the industry is now facing tougher operating conditions as a result of the new risk landscape. As we face the challenges ahead, two of Illion's analytics leads were asked to present a keynote at ARCA's Summit in Sydney. In this video, we'll be hearing from Lewis Sang and Barrett Haseldine. We'll be sharing insights to help you make better decisions. I'll be asking Lewis and Barrett how lenders globally are making use of new data sets and how they're looking to navigate the challenging economic conditions. So sit back and enjoy. And as always, if there's anything you'd like to know more of, please get in touch. So Lewis, I might come to you first. So your team tracks consumer spending. Can you take us through some of the big picture insights and trends you're spotting?
Sure, Mark. So the key takeaway is that people are still spending, but just spending in different categories, and it's been up and down depending on what you look at. So in terms of cafes, restaurants and pubs, the spend actually has been around the same year on year, but more discretionary items such as retail, consumer electronics, bigger ticket items definitely have been down around 10% year on year as the cost of living struggles bites.
So Lewis, with the RBA raising interest rates again and the current cost of living crisis, what areas are we seeing consumers pulling back on in order to balance the books?
So the spend on essential and discretionary goods have definitely shifted. We are seeing people winding back on discretionary spending. So I mentioned retail before and kind of your bigger items, but in terms of supermarkets and foods, that's still being spent on. You know, people need to eat. However, the categories which people consider essential and discretionary have, I think, slightly changed. So things like insurance, health insurance, spend actually been down a bit, about 5% year on year. Although interestingly enough, things like spending on doctors and meds have actually been up around 10%.
And if we think about consumer lending delinquencies, can you expand a little bit more on some of the data that we're seeing?
So consumer delinquencies, on average, they have been going up year on year, but it is slightly different depending on which retail product you're looking at. So on the unsecured space, so credit cards and personal loans, that has gone up year on year around 20% on the 30-day rate, and they're always at a higher base. However, mortgages is the big one that everyone's been talking about. Mortgages arrears have also gone up. So on the 30-day rate, it's gone up around 28% year on year, about 15% on the 90-day rate. So there's definitely a stress, I think, in the system. If you look at it by different vintages, so the more recently written loans, so from 2022 onwards, we are seeing those loans going into arrears quicker than what we see historically. So I think it will be a challenge for lenders to manage that.
Thanks, Lewis. So it does sound with all that data that sort of fiscal cliff may be upon us shortly. I want to switch gears though. And if we think now to businesses, what are businesses doing and thinking, and what insights do we have on how they're tracking?
Yeah, sure. So businesses, we look at a few key metrics here. Insolvency is a great lagging indicator. That has definitely been up year to date. We've actually had more insolvencies now compared to the full 2022 year, mostly construction, retail trade and manufacturing. We also monitor trade late payments, so how late businesses are paying other businesses on their invoices. On average, that's been around kind of 14, 15 days historically. Overall, it's kind of shot up to around 17, 18 days for some of the riskier industries, so it's definitely going up. We also track activity or in our Illion Growth Index, so it gives us a measure of activity compared to a normal period. And we're seeing that play out in different industries as well. Manufacturing actually has been doing pretty well, whereas food services and retail have been really struggling, down about 5 to 10% on that index alone.
Thanks, Lewis. I'll switch to Barrett now, but I do want to stay on the topic of industries. Perhaps you can share some insights on what your team is experiencing around industries that are more at risk than others.
Absolutely. So we undertook a research study recently that delved into industry-based credit risk. And what we saw is that unfortunately the industry that takes the cake for being highest risk right now is food services, with about 14% of businesses in that industry being at high risk of failure in the coming year or worse. Following that is construction at about 11%, and then there's retail and transport at about 10%. Contrast that to financial services and the like, which is about 3.5%. Those industries really are showing significant risk. Now, for retail and food services, typically they perform quite strongly October, November, December, January, but come February after the Christmas rush, sometimes those businesses do show elevated risk, so that's something we're watching through 2024.
Now, Barrett, Illion has recently introduced a credit stress barometer. And I know that you've been in the press discussing it and talking about some of the insights that we can learn from it. Perhaps just for the viewers, you can expand a little bit more on it and some of the insights that it's teaching us.
So Illion's credit stress barometer really tries to summarize all the insights that Lewis shared earlier about how consumers are going. So as he mentioned, there are many more households falling behind on their home loan repayments, credit card and personal loan repayments. And as a result, what we've seen is that credit stress actually has grown markedly since Christmas time. In fact, our barometer is about 11% higher now than what it was back in January, which means that we're estimating that about 11% more households are going to be struggling to pay their bills this coming year than what we did a year ago. So it's definitely quite worrying insights.
So Barrett, you recently spoke at the International Credit Conference in Edinburgh. Love to hear more about some of those topics that are on international credit managers' minds and what's Illion doing about supporting them.
Yeah, so it was brilliant being able to travel over to Edinburgh and present 3 separate research papers that we've undertaken. One of the big themes that came out was lenders wanting to use different data sources to be able to inform their credit decisions. So moving away from only using bureau data to complementing that using transaction risk data. So that's something Illion has focused on strongly over the past 5 years to be able to support Australian and New Zealand credit providers to leverage new insights regarding income stability as a predictor of risk and other expense patterns. The other big topic was artificial intelligence. So there's been a lot of focus globally on being able to get the right outcome from AI to be able to get strong outcomes for consumers in terms of being able to have quicker decisions, but also good outcomes for credit providers, being able to reduce their bad debts and approve more customers. And some of the work we've been doing in artificial intelligence has enabled us to be able to create a new credit score that we've released this year, which factors in insights from AI to make it a lot more predictive than the previous generation score.
Thank you, Lewis. Thank you, Barrett. Always a delight to hear your insights. I could be here all day listening. Well, it certainly is a challenging time ahead for credit risk professionals. I hope that you've enjoyed the video, and if there's anything that you'd like to hear more of, please don't hesitate to get in touch. I'm Mark Russell. Have a beautiful day.